So let's continue this discussion later. Mr. Boyagoda, welcome. Thank you for taking your time to give us a very important topic, the current economic situation and the way forward for companies. A lot of us are not seeing a very rosy picture. So you can start your presentation and talk to us, and then we'll probably have a lot of questions after this. We can, I think Patrick is controlling the...
yeah. Just to introduce Mr. Mangala Boyagoda, he is a very senior banker in the country. He retired from the Standard Chartered Bank as a CEO. Prior to that, he was head of treasury at Bank of Ceylon. He has worked in Bank of Ceylon London branch also as a manager. And now he runs his own investment banking company. And he's in many boards. Actually, he has also lost the count of it, and I have also lost the count of it. So I'll introduce Mr. Mangala Boyagoda. He's a very, very senior financial analyst in the country. He's on our board as well. So over to you, Mangala.
This one.
I will control. You can talk. I will.
Thank you very much for this opportunity. I will only share my experience and my thoughts on economy, and we'll discuss the way forward for us. To go back, our GDP, look at our GDP for the last 23 years. Right, it started with 20 billion and gone up to 83 billion, that is 2021. But 2022, it dropped 8%, 8.8%. Now the GDP is $73 billion, 10-year low. Right? This economy, if you could compare our neighbors, Tamil Nadu, 10 years, 15 years ago, their GDP was 85, we are 45, they are $311 billion US economy. We are 73 billion. That shows their vision and our vision for the country. So with that backdrop, if you go back to the slide, look at our inflation. Our inflation, because if you look at it, we have seen 2006%, highest we have seen 2008, and gone up to over 60%. Now it's on 50% basis. But I want to focus you to 2007 to 2022, what has happened to our economy. The reason, up to 2007, our total budget deficit funded through the domestic borrow. That's what we have seen before 2007, our interest rates were high. Everything on the domestic market we borrowed. The change took place after 2007. Right. Now our foreign reserves, up to 2006, we have only had about 3.3 billion. Then 2013 went up to 8.3 billion. We thought it's going to boom. So we have so much of reserves, and the country is performing well. Today, less than 1.8 billion. If you take the swap out, only 300 billion reserves, 300 million reserves we have. What has happened to the reserves? Very important for us to understand. But now our foreign exchange rate, up to 2006, we have the 102 level, up to 2014-15, the static, very little change took place. We lost our export competitiveness during that time, without our knowledge. This could, other countries, they depreciate their currencies, the export countries, right? And we lost the competitiveness. Due to what? Now look at it. 2006, we allow foreigners to come into our domestic debt market. The first time. When the dollar interest rate of 0.5%, our 5-year bond rates were 14 to 15%. When we open we said 10% of our domestic debt we are going to give to foreigners. What has happened? It was not rocket science. People brought dollars from overseas, Temple and all the big funds, they convert into rupees and we invest in domestic debt market. what has happened? Our reserves went up. Then the currency started appreciating. One time it was 119.90 exchange rate, came to 109.90. Market couldn't absorb, local banks. Central banks start buying these dollars at 109 and pump rupees into the system. Reserves went up to 8.3 billion. So much of money came to the market. Treasury bill rate collapsed to 6%. We thought high reserves, low interest rate, economy is performing. Now look, now this chart will show you that from 2007, the foreign flows came, how these foreign flows came in 2007, 8, 9, and 10, and 12, and 13. The highest we got $3.6 billion came into the country by doing this. It was not rocket science. Because we offered 15% return when the dollar interest was 0.5%. When they came and converted through the banking system, because the exchange rate started appreciating and the rupees came to the system. So the central bank bought the dollars and increased the reserves, and the interest rate came down. So that was happened 2000, 2006 up to 13. After that, what has happened? The person who bought the bond, a 5-year bond at 15% for 5 years, they got a return of 75% for 5 years, but the rupee depreciation was 22% in these 5 years. They got 9 to 9% on the platter when the dollar interest rate 0.5%. That's how our country silver, but foreign exchange earnings went out of the country. So then what has happened? When these bonds are maturing in 2012-13, there were no interest by the foreigners. Why? Interest rate 6%. From 15%, it dropped to 6%. What they did was, they converted back and took the dollars out. Then only the crisis started. Because our fundamentals are not in place to offer foreigners to come and invest in domestic debt. Right? So then floodgates open, no rocket science. They saw the advantage and invest in Sri Lanka. We thought people have the interest, but no foreigners love they didn't keep the love of the country. They saw the advantage. And they are 0.5% dollar against 14%. When they came in, the rupee started appreciating because the market could absorb. They got the benefit from both sides. That took the country foreign exchange out. So this is the story, and that's what the interest rate. Look at it, the chart is the second one, the down. This chart is the interest rate. When the interest rate for 2007, 15%, when the first the punch came in, interest rate came down to 6%. So it went on like this. When these guys are pulling out, interest rate up to this level. Now, only 32 billion rupees only available out of $4.2 billion. Rupee terms, only 32 billion worth of foreign exchange the foreigners are holding in government securities. Very minute amount when you compare to the $3.6 billion. This is the chart. How they came in, how they pulled out. In 2007 to 2022, this is what has happened to us. Okay. Now, after that, we said part of the budget deficit, we are going to fund through the foreign borrowings, ISBs. First ISB we issued in 2007. Then every year, this is the interest we pay. Coupon 8.25, 7.5, 6.25. Like the last one we took sovereign bonds, 1.5 billion at the rate of 7.5%, 55% interest. The maturity 2030. We have borrowed 16.5 billion during this period by issuing sovereign bonds. This also reserves also came and add to the reserves. Government borrowed the dollars and gave to central bank and got the rupees. But during this time, out of this borrowing, 4.5 billion we have only settled. Now the sovereign bonds outstanding is 12.5 billion. That is why the last April we said we have no reserves to pay. Now our budget deficit is for development or consumption. Consumption. We borrowed foreign currency for consumption to pay salaries, pensions. That's the price we are paying today. So the foreign reserves went because we thought that rather than borrowing domestically at 17–18%, better to borrow at 7.5. And we borrowed and settled it, but long term, in the debts are paying, we didn't have any foreign reserves. In the meantime, out of this borrowing, there are bilateral loans. They are borrowed from China and other countries. The country was supposed to, they were forced to pay these loans. So there's no other option. We went and borrowed foreign currency because we didn't have our reserves, not export were not enough to, to meet the payments. So this is a second thing. That's why we are defaulted this 12.5, and now we are asking them to give a haircut. We look at the sovereign bonds. When the interest is 1.5 to 2%, what's the premium they have charged? 5 to 6% premium. Then they have taken the default risk. Once they take a default risk, right? When there's something they are not paying, they must absorb it. That's my point. That's also my thinking. Because already these sovereign bond people, they have already taken the hit in their books. Because these sovereign bonds, the 100 rupee came down to 40–30 rupees. End of the month, they have to mark to market. Every 1 billion, right? 330, 700,000, they have written off out of their PNL. So if we can offer even 60, they will happily accept it because from 300, now they are getting 600. That's how the negotiation should take place. Because they have came for sovereign bonds by taking the risk. And that's why we got that we pay the risk premium. Higher risk premium we pay. Now the negotiations are going on, we have yet to see how best that they will negotiate. Right? That is the sovereign bond point of view. Look at the sovereign bonds, how we have issued sovereign bonds. Outstanding on 2021, right? The time, right, is 12.5 billion. Many of this money went for country development. Any development projects that we have done to earn foreign exchange. No harm of borrowing money. If you can deploy and generate foreign exchange for the country, didn't happen. Went for consumption. Look at it. This is sovereign. This is stock exchange point of view. Right now, this is how from 2000 onward our stock exchange performed with the SPI. How much money came in? How much money went out of the country? SEC also playing a vital role getting the foreign exchange into the country. So at this hour, you see the amount of outflows we have seen with the downturn of the economy. Yes, sir. Okay. Now look at the interest rate movement. Now we have seen the interest rates, treasury bill rates have gone up to 30%, bond rates have gone to 32–33%, and the AWPLR is 24%. Huge anomaly. Because the risk reward structure, the treasury bill should be the lowest rate, bank rate should be the higher than the treasury bill. But in this case, right at this hour, banks are lending lower than the treasury bill rate. So because the anomaly is the risk reward structure, because the government is the biggest borrower. When the government is chasing money for crowding out effect to meet their budget deficit, they have to pay a higher rate. Now, right, that's what's happened. After 2019, we could go to the international market to borrow. So entire budget deficit funded through the domestic borrowing. So always when you borrow domestically, you have to pay a higher rate than the banks to compete with. Now, because of that, the corporate sector can't do anything. Because at the moment, better to borrow from the banks rather than issuing even a domestic commercial paper. Because commercial bills are much expensive than the bank rates. It's huge anomaly in the risk reward structure. So that's now here, if you look at it, the 5-year bond and the AWPLR and the 1-year treasury bill movement. Now, this year, how it's going to perform the matter to us. With the inflationary pressure, that what we see, this year the inflation will come down below 20%. That is why when yesterday I'll come back to that. This is the interest rate movement point of view, Patrick, is how the interest movement. Now, it's the personal remittances. Look at it, our inward remittances from worker remittance. Highest we got 7.2 billion in 2022. Now, last year we got only 3.3 billion. If we can go back to 6 billion, our problem is over because we are not paying any foreign debts now. If you can go back to that level, we have more reserves, we can build our reserves. That's why I said our GDP is very small, very easy. It's a pocket money or somebody to put it right. So the effort and the policy framework has to be there to attract this. Now,
this has come up a little bit now, right?
Now this month. This month. This is no, last December it was 400 million. Right now, these are the remittances for that particular 2022 end of the year. 3.3 billion we received. Now last week, because the black money rates have dropped below the bank rate, so that people are sending money through the banking channel. So because of that, the remittances are increasing. Amounts are the amount of the inward remittances numbers are increasing. That is why central bank removed the ban. And all of a sudden, exchange rate came to 320. Because panic sellers came and sold the dollars and brought it down. The central bank has bought $337 million. That's correct. That's right. That's the market says $337 million. Now, from the market. From the market, exporters got panic.
Avoid crashing.
Crashing. Now, central bank is there 320 levels.
So the remittances will come down.
No, it can't come down. No, I think they have. That's why I want to come back to you because we must have a strategy to manage it. Right? Okay. Now the central bank is coming at 320 levels. They are holding the dollars.
It had gone down today.
Yeah. No. It has got 328 today. 326 today. Yeah. To go up. Yeah. 330. What is previous day? Today 323.
13. I got 318.
Yeah. 1 week. Yeah. Look at the inward remittance to the tourism. The highest we got 2018 4.5 billion. Now last year 2022 we got only 1.4 billion. If we can go to 4 billion. Right, our import bill is reducing. Now 17 billion our import bill. Export bill is 12 billion. 5 billion is a net difference. If you get 7 billion inward remittances, plus the tourism one go, we have a surplus. We have a surplus, we can accumulate dollars in order to repay the ISPs and the foreign loans later. Now look at the debt, the total debt 2020-21, right? So many billions of rupees. The 18 trillion, that is already 18 trillion rupees to be owed, domestic and foreign.
In rupees.
Yeah, rupee terms. Now 1951, we have issued the first treasury bill in this country. At that point, the government, you are going to front of the government to get a limit. The limit was given only 10 million rupees to borrow. 1951, the first time they issued a commercial, the economy was small, the GDP small. Today, 18 trillion, what we have done? 18. What development we have done to the country? 18 trillion today. with 10 million rupees in 1951. Limit was given. First treasury bill was issued in 1951. For the 10 million, today our GDP is 73, but our debt is 18 trillion. That was the consumption for political reasons. We have given money, everything free, and the price that we pay. Then today, everybody is paying price. Yes. Next slide. The domestic debt. This is the treasury bill, treasury bonds, and the treasury bills and the bonds. And then the rupee loan, because earlier, prior to issuing the treasury bonds, the government borrowed money. We have a rupee loan. They gave a fixed rate, and they could go to the market and borrow. Now once they mature in, they are now issuing treasury bills and bonds for that. These are the old maturities we are taking. So the total outstanding is about 13 trillion. 13 trillion domestic debt alone. So the Guyana had to pay for this one day. So that's the debt crisis we are talking. The debt sustainability, that's what the IMF is asking. How are you going to pay your debt? Both foreign and local, right? And they said, okay, come with your debt sustainability program. That's what they're asking. Debt sustainability program is what, how much your revenue, how are you going to pay your debt, both local and foreign debt. Yes, sir. Now look at the market liquidity. The market liquidity is the black part is the shortfall. Why the market liquidity came minus? Because when the central bank reserves went down, the government has bought dollars from central bank by giving the rupees to the system, to the central bank. And the reserves came down. What has happened? Market liquidity went to central bank kitty. Then the market has a shortfall of liquidity in the market. Because how the central bank operates, because whatever the foreign exchange of central government sells to central bank, they buy and give rupees. Then the reserves goes up, rupee comes in. When the government or central bank sells dollars to the market, they have to give rupees to buy the dollars. Then they drain this money out of the system. When our reserves went below to 300 million, all the rupees have been drained to central bank. Then the central bank has to pump 3.6 trillion rupees to the market because the entire liquidity went to central bank. That's called the printing of money took place. With all that, money is the shortfall. For a day, about 800 to 900 billion was shortfall was there. There was a reason for it. Because when we defaulted in April 12th,
Yes.
April 12th, saying that we are going to pay our SBR, ISBs, sovereign bonds, then the foreign banks had a problem. Now we became a failed state. They couldn't lend their money even to central bank, neither to interbank. So all the foreign, out of 24 banks, 11 foreign banks, they didn't come to the interbank market, neither they didn't invest their money in the treasury bill. They went to central bank and parked their money overnight at 14%. 350 billion to 400 billion on a daily basis went to central bank at 40.5%. Then the other local banks were short about 800 billion. The central bank has to pump this money from at 15.5% from central bank.
Other banks.
Central bank holdings. Central bank holdings. Right. That's called the overnight. The policy rate of 40.5 and 50.5 took place. One is the lending rate, other one is a borrowing rate. So when you want to borrow, you have to give a treasury bill to central bank. When you access, when you lend, you go and park with the central bank. All the foreign banks withdrew from the local market even today. That is why the market is upside. The market is, the players, their hands are tight. That sense, only the local banks are in the interbank market and treasury bill. That's why the treasury bill rates are also moving up. Foreign banks are not investing even in a treasury bill. Because they can't invest. If they invest, what will happen? Their head office has to pay the 100% capital adequacy of the investment. Because we are a failed state. So that is why the foreign banks offered 9.5% for their 1 year fixed deposits. People still invested and they went and bought, invested central bank at 50, 40 and half. That's how the foreign banks manage their liquidity. At 49.5 to 10% they paid for depositor and invested at 40.5% in the central bank. Look at the liquidity shortfall now. Now the central bank has pumped 3.6 billion rupees into the system. Sorry, 2.6 trillion. And the market shortfall is this. Now, how to avoid this? Now the central bank has to get more foreign exchange to the country. If the central bank buys dollars from the banks, they pump rupees into the system. Now, gradually that's happening. Now, if that happens, what will happen? The reserves will go up and the rupee will come to the market, it gets balanced out. So we need at least $1 to $2 billion inflow to the country to correct this situation. That's all the liquidity situation of the country. This is the foreign debt 2021, how with ISB's to outstanding is 12.5, the bilateral and multilateral loans we have borrowed. Now challenges. For do anything, we need the political stability. So what is the first thing? Because the IMF now they are going to sign the agreement by end of this year. The China has already given the approval. This year? This month. This month. This month. This month. Then we need the political stability is very, very important. Second is the global growth. According to the World Bank, the GDP in the world is going to drop to 1.07%, the lowest up since 1970s. In that sense, how our exports is going to impact is very important for us. Growth also very important. So the commodity prices will come down. Right? And now we have seen this coming down. Right? With that, that's another thing that the exporters or the corporate world has to look into. This is another challenge in front of us, how we position ourselves. With that, if you are an exporter, the rupee appreciates, your competitors is going to vanish. In that sense, that's how we position our business is very, very important. Other is the monetary policy. The central bank main objective is interest rate and exchange rate. Now, when I showed you what has happened 2006 and 2001, 2015, what has happened? That is why 2015, when these bonds were maturing, foreigners pulled out. That's why the UMP government was forced to go to IMF and borrow. Because our reserves left, because the foreigners pulled the money out. Now with the IMF facility, I see another opportunity for foreigners to come in. Interest rate, treasury bill rate is 29%. And when IMF, the watchdog is there, they will come and raid our country.
Again, the same cycle.
Now to avoid that, the central bank should be smart. Because earlier what has happened, all the money central went through the banking system to meet the imports. That's why the rupee started appreciating. If the central bank, I think Chambers you all can take this matter, because if you all can say central bank, only the current account transactions, import, export, goods and services should determine the exchange rate. Any other flows, you take it direct to central bank and manage it separately. Then there is no undue pressure of managing the foreign reserves. Earlier what has happened, what we borrowed, sold to central bank and got rupees. Right? If you can say, I see a lot of inquiries in the market to which point to come into the debt market. Cowboys are there. Because most of they know this happens, rupee is going to appreciate. They are going to get the benefit from both sides. So the central bank should be smart at this hour. They must now, earlier they said 15 or 25% of inward remittances must sell it to central bank. Now they have withdrawn that. Now they must come out and say, hey, anybody is buying with IIA account or the foreign direct investment or treasury bills must sell it to central bank separately. Then central bank can manage that liquidity, and if there's a withdrawal, they can give it. Otherwise, it's going to distract our rupee exchange rate. There will be huge impact. Artificial appreciation is going to hurt exports. So if you can really goods and services have separately to manage it, what will happen? That will decide the real exchange rate of the country for some time. Until we build the reserves to meet it. But if you also want to show rosy picture politically, they allow to come and to 200, you ask it for trouble again at the 4 to 5 years time. Right? And again, now one thing, earlier 2007 to 2014, they allowed 12.5% of the treasury bill domestic debt to foreigners. After the government came in 2015, the governor Indrajit Kumarasamy, they brought the ceiling to 5%. Now only foreigners can buy 5% of the domestic debt. That's a manageable. This, even though that 5% mustn't go to the market, central bank must absorb it. Any foreign direct investment in equity, if you separate it, then the goods and services, for that matter, travel, imports, exports, that can decide the realistic exchange rate. Not going to harm anybody, because undue advantages is not there. So that's the central bank, for the monetary policy and the exchange rate management is very, very important. Second, the central bank role is managing the inflation and the exchange rate, the two things. But the interest rate wise, what I will see, they will now, IMF want to request the central bank to increase interest rate by 1% 2 days back. The reason, because when the rupee start appreciating, if the interest is, they put the interest rate down, there will be more demand for imports. To curb that, they are keeping the interest rate a little bit high until the country stabilizes. That's a very good strategy at this hour. I should say that the lending rate should be somewhere in 21-22%, which for some time, by end of this year, then gradually, when the economy is stable, when they get more reserves, we can gradually adjust it. Otherwise, import will consumption, import will increase. So I think how you balance is about but the monetary policy is very, very important. The fiscal policy, the government tax revenue. Now we have seen taxes 35-36%. Now exports, we got an incentive that's also not there today. How the exporters are going to survive? Because this country, if you don't go and support the exports, it will be export economy. If you don't support the exporters, I don't think that we can get the desired results for us. So most of the fiscal policies, government fiscal policy is very important for us to understand how the budget deficit they are going to. And the IMF targets they are given, that gradually they have to bring the budget into 4.3%, 4.5% of the GDP by 2025 or 28. For that, the government has to now come with a plan. Every year, how we are going to reduce the debt component, the borrowing requirement, and increase the revenue. Against the yesterday to day before to today, our GDP has gone up. Why? Rupee appreciated 50 rupees. Automatically 73 GDP must have gone up to 78 to 80. Right? So by doing that, they can adjust the numbers now. Because GDP to debt ratios, all that, right? That can happen. So that's very important. Debt sustainability. Now there's a rumor saying there can be a haircut of the domestic debt. For me, I don't see any room for us to have a domestic debt here. The reason, because our government bonds, our treasury bills 3.3 billion, 2.6 trillion, 3.6 trillion, out of 2.6 trillion, the central bank holds it. Only 1 billion outside banks and other 1 trillion other banks and the other institutions. Then out of the bonds, 9.8 trillion of the bonds, 44% by EPF is your money, right? And 24% by the banks. Now people got a 70% rupee depreciation and also inflation 36%. They have nothing to cut. They are cut on the domestic debt. So I think you all have to come with a proposal to the government because it's going to affect your employees, right? Everybody is going to get affected if they're going to have that. Actually, Patrick knows I said a proposal to central bank, governor and the president saying there can't be a haircut, no haircut, but we'll try to do the extension of the maturity. Now, if you look at the ETF, EPF, it's a long-term investment. The insurance companies, life insurance, 30% of their investment should be long-term. In that sense, what we can do, we can take a part of the portfolio, take the realistic interest rate and convert to a perpetual bonds. Perpetual bonds, no repayment. But until such time, the fund is going to grow. It's going to grow every time you are going to invest. So by doing that, the debt burden we are taking out of the country. And it's been win-win solution for everybody. And likewise, I think we all have to sit down, but that is our role, to sit down and come with a strategy, the government to do this and push them.
We have started offering the government basically
All the corporate, all the debt. That is 27 bond, 20% yield, 27.29 yield, 27 year 27 bond.
But wouldn't the bond market crash with that?
No, that is now what they are going to stop with the loans.
Yeah.
No, then the bank will hold it. Now, instead of a loan, you can give the bond to the bank and fight off the loan. You are stopping.
Oh, can you do that? Okay.
You are stopping. You are stopping the this thing. So the bank will take the bond.
Will the banks take it?
Yeah. That's what that's the agreement. 27.2 is a good rate for the bank. The AWPR is 24. No? AWPR is 24. They are getting 27 and a half.
They are upon the deal. They are upon the deal.
They are upon the deal. So that there will be.
They have faith in the system.
They have to have. Otherwise, they're non-performing now. The loans are non-performing now. They don't get it now. So for that, they are willing to accept it. All right? Against the loan, you can swap it. So likewise, that we have to come with the strategies to take the to solve these issues. The exchange rate and the interest rate.
Can I just ask one more question? Now, that is only for the people who have the loans. What if the borrowings are the debt is to be, servicing the cash flow?
Then if you are serving the cash flow, then the bond is there, you can sell it in the market.
You can sell your bond.
That is why I asked you the question, whether the bond market will crash with that.
Bond market today, the treasury bill rate dropped by 1%. Anticipating inflows, foreign inflows. So that means wait for some time, you get capital gains. You can sell at a discount and make a capital gain. You have the holding power. If you have cash flow, why you want to sell it? Because you are getting 27.39% return now. So no investment will give. The banks offering 70% for 1 year.
Business will never give it.
Yeah, no business will give that return. So you're the this rate, right? The most important, the exchange rate and the interest rate volatility. We have to see. So if the central bank doesn't come in, there can be a volatility. It can impact the exports. So I see the interest rates gradually come down. Treasury bill rate will come down to 18-19% of this year. The bank rates also remain at that level. Now there's the commodity prices. The commodity prices is the one that the volatility world economy volatility. With that, I see the commodity prices will come down. If you really manage your imports such a way that you can have a better benefit. The market liquidity will improve. Because the central bank buy in dollars and the liquidity system, that will give more rupees into the system. Capital flows is very important. I say capital flows what? Way of treasury bill bonds. And also, I see a lot of Indians will raid our equity market. All the big companies, they might, because 70% cheap for them. Our companies, to the right time, they will raid. I see a lot of inflows. Inflows will come through the equity market. You won't manage it properly because That because of some share, bank shares, everything below the
Yeah, book value.
book value.
Majority.
Yeah, so good buys for them. So without our knowledge, they might attack our economy. Long run, I don't know, but that can be the starting point. They might come to the quick market. For them, that's our rupees still quite cheap now. Our company and the shares.
The company has value.
Yeah, value. That's what I'm telling you. Yeah. Now, other thing is the economic reforms very important. Against the corruptions and all that, I think we need reforms. This country, plus 70 billion GDP, we can turn around really easily if we have the reforms and the legal framework to put that right. Even against the corruption, I wrote a paper to a president. What is the corruption means? Still I'm asking. End of the day, somebody giving money to somebody, go to your bank and taking the cash. So I said, why don't you withdraw the cash 5,000 rupees from the market? You want one month time for them to deposit back the banking. Withdraw only 1,000 rupees the currency we are going to operate in this country. After that, what will happen? Any transaction of $1 million through the banking system.
Recorded.
Overnight, we can stop corruption. But I got a letter saying, good idea. Yes.
I said the same thing. But
I think that's the chambers must take these things. And you all must lobby to do the right thing for the country. Because very simple. We don't want anything.
That was Lakman, that was different.
Even Modi is the
Right.
That was the difference. Now, what he is suggesting is to withdraw the 5,000 rupees.
Out of the market.
notes out of the market.
Completely.
Not
No
to-
5,000
not to
rupees.
reissue another note.
No, not another note. Ask them to deposit the bank. Entire money will go to the bank system. Bank will flush with the rupees because all black money will go to the system. Hawala system, we can stop it overnight. Why? No cash. Anything 1 million transaction through the banking channel because we are electronic banking. If you do that within 24 hours, we can stop this. We have the
At least we can minimize it.
minimum.
You're going to do that. They are the biggest culprits.
Exactly. So they are laying the foundation.
That is another thing. That is
They are the people who are the foundation.
chamber. Everybody has to lobby for.
Now, I can remember, say 5 years ago or 10 years ago, Indonesia had 10 million bill. 10 million rupees.
Very simple. But ask
10 million
if you want, get together.
10
Do it.
million
Very simple.
in Indonesia, and there were 10 million notes.
It should be a will. We all have to
Now,
fight for it.
100,000 is a high
People
number.
must get together
Hmm.
and fight for this. Right, do the right thing for the country. Otherwise, again,
Yes,
those
but
things go the other way.
5 billion autos.
Now look at the world biggest economy. America, $100 is a currency.
We don't take it, even
Yeah,
$100.
everything is credit card now.
You take $100 bill and.
Without paying with the credit card. It's transferable. ගන්න you can get a take up on that. they ගන්න. credit card එකෙන් ගෙවන්න කියලා. ඒකට අපේ තේ system එක දාන්නේ banking system, sophisticated banking system. Electronic banking very strong in this country. That's for time.
That's how Rwanda came up.
Yeah.
That's how Rwanda came
Yeah.
up. They stopped the currency trading.
That's trading. Hawala system, everything. We will stop. Everything will come through the banking channel. It is a matter of 1 month we can put things right. But if there's will.
Very correct.
So with that, the financial stability, the banks, now today everybody is talking the banks, the non-performing assets and all that. There should be a mergers and acquisitions. I see we have too much of banks here. So we have to force them to merge and 5 to 6 local banks. And finance companies also should merge with the bank. That is the strong way that you whether any.
Why do you say that?
Because it is strong banks, international to deal. Because
Balance sheet.
balance sheet is important. Have a very strong banks. If you have that, I think this country GDP, we can within 3-4 years, we can.
Collectively, our banks put together, what's the balance sheet you can expect? Let's say five banks, right? Guess.
Bankers still on 3 trillion. 3 trillion, 3.5 trillion, People's Bank 2 trillion, 5 trillion, 5 trillion, commercial bank,
Actually, small banks,
We must know that. Now must get together and must merge it. So that's the way forward for us. We should have small banks to deal with international. With a strong balance sheet. So these are the things, challenges in front of us. Then, way forward. Financial risk management. I think most of the corporates I have seen, I know a lot of people are calling me. Tea prices have come down. Now people are shouting, the tea manufacturers will go under. Why? So one reason they held on to their stocks and thinking the price will go up. So when it's coming down, now they are shouting. On the other hand, the exporters, they went and borrow rupees and without borrowing dollars for their working capital, they borrowed rupees in order to the rupee to depreciate. Now they are also in trouble. So it's because in that sense, you manage that. Because that's why I said country doesn't have a treasury management. Our treasury, Sri Lankan, our treasury doesn't have a treasury management. Central bank doesn't have a treasury management. Our corporate doesn't have the treasury management to manage risk. There is no business called risk-free. We say treasury bill risk-free. Risk-free is only a credit risk-free. The time that you buy until the maturity, you run the interest rate risk. So in that sense, you have to identify commodity risk, all that you manage. As a country, petroleum risk. Look at the oil prices. When it came to 28, nobody was going to hedge. Right. So that's treasury division. The central bank treasury, our country treasury must have a separate division to manage the risk of the government institution, commodity risk. Separate division. Doesn't have it. So that is the thing, even the corporate point of view, I'm telling you, you all must have your risk management, whether big or small. Have to identify the risk and measure it, use the real appropriate hedge in this thing. Liquidity management is other thing. Then the reserve management, central bank, I'm telling you, the central bank point of view, how you manage the reserve. If you have all the IIA money, they must put it, take it and have it managed separately and allow the inflows, outflow from the current account transaction to decide the exchange rate. The realistic exchange rate we can see without any influence. At a particular point, if they see the high or low, they can intervene. But first, allow them to settle down the rate. That's very important reserve management. Domestic debt, there is no room for haircut. For me, I don't know what the government will do. Right? So if they cut, the poor savers going to EPF people going to get hurt if there's a haircut. Because their last year EPF return is 9.8. What they have to cut? 9.8% return you got, right? What they have to cut if they cut 20%, what will be the situation of these people? So that is that we have to take.
Banks also will. Banks also will.
Yeah, no, there's enough ways you can sort out this. Perpetual bond is the answer because there's not good. No, nobody's going to lose anything. Now, supply chain very important for you all. Management with the global the commodity prices coming down, you manage it properly, so you can make money. Other thing is the financial literacy. That I did my was for the last 40 odd years of financial literacy. This country, we say we can read and write, that doesn't mean nothing. Today we are in a global village. Without financial and IT literacy, no country can prosper. So I think that we have for our curriculum, we have to have the financial literacy part of it. Otherwise, even 2050, this country won't go forward. Right? That is the situation. Because even the professionals, I know they know how to earn money, but they don't know how to invest money. That's it. Because a lot of awareness is important. So I think the chamber can do a lot to overcome these issues. You have to lobby the government and ask what you want to put the country the right track. Because this GDP, very small, we can turn around. There's no issues, very, very small GDP. How you put things is right, it's a matter to us. Your contribution, your involvement is, I think, essential at this time to put things right. Thank you very much.
thank you.